critical aspect of it. And they never deviate from it. That's why they're successful, whether they're up, down. And again, they don't get emotional about it. Pointless. So you want to be like the casino, right? We want to be the house. We only want to trade when we have the odds in our favor. You have to learn what that looks like, though. Okay? And then, of course, you have to have the decisiveness once you recognize that opportunity to, of course, pounce on it. Right? Okay? So that's how you want to think. The reason I bring this up, whether I'm doing one of these orientations or I'm teaching a class, this is so important to understand this. Because, again, it's the psychological aspect of trading that, in my opinion, is the hardest. That's typically the last hurdle for most students. I could bring in a student that's been here maybe 3 months. And they can recognize a great setup on the chart. That's not a problem. It's not hard to teach them. I can teach everybody in this room how to recognize high probability turning points in the market. But just because you can recognize it doesn't mean you're going to be able to make money at it. Again, when you start having real money on the line, what's going to happen to you emotionally? Is your emotions going to start clouding your judgment? Yeah. It's just like some of these professional athletes where they do well maybe during the regular season, then they get into the playoffs and they kind of choke because maybe they're feeling the pressure. They have the talent, right? But sometimes you get certain players for whatever reason their stats go down in the playoffs, whether it's baseball, basketball, football, whatever it is. Why? And then others rise to the occasion. As we saw in these finals, right? Like what happened with Durant, right? He just rizzed it. He's like, the moment wasn't too big. Okay, that's a lot of pressure. But yeah, when you're trading, there's pressure. It's the pressure of losing money. That's the pressure. And for some people, that pressure overwhelms them, right? So that's why we spend so much time in our training here, in our classes, and in our mentorship rooms, our live trading rooms, talking about it, doing exercises to get traders to think professionally, like a professional trader, right? What I call the winning mindset. Okay, so it's really important that we have our mind in the right place. Okay, all right. Okay, let's get going here. All right. So this is what we call our trading foundation. Okay, so every time we put on a trade, we want to make sure that we have all these facets present. Okay, and I'll even make an argument that some of these pieces of the pie should even be bigger, right? Even a little bit more important. The first one is risk management. So again, risk management is how I protect my capital. Again, if I'm wrong on a trade, how much am I willing to lose? What's the prudent amount of risk, right? 3%. That's a little bit high. We'll talk about that.
You don't know yourself.
No, we'll talk about that. It depends. Depends on the particular setup. Okay. But risk management could be how much. Here's just some examples. But you go into a prudent risk management plan. How much should I risk per trade? Right. If I'm a day trader, are there certain times of the day that are better to trade than others? Or should I just sit there for 6.5 hours and just do this? Should I just do that? I should or I shouldn't? Should not. I agree with you. Okay.
I've never lost money doing that.
Well, I'll tell you what. The first 2 hours of the trading day are the best time to trade. Right? We'll talk about later why that is. Right. There's certain times that are going to be better than others, or you're going to have a better opportunity to get that particular setup that you're after. Right. Okay. How many? Here's another example of risk management. How many trades should I have open at the same time? I mean, should I be in 5 different stock trades at the same time? 10?
No.
Right? If that's too many, then why? Right? So we have to kind of address that. What asset classes are appropriate for me to trade based on my financial objective? Just stocks, mutual funds, futures, forex, options, Bitcoin? Has to be addressed. Not every asset class is going to be appropriate for a specific type of trader. Okay? So we have to learn that too. Right? Where should I put my stop loss? What's a stop loss? Anybody know? This is a big one. Probably hear me say the word stop loss at least 25 times between now and Sunday. Stop loss is really the point where you're proven wrong. It's how we mitigate or define the risk on the trade. Where do I know? How do I know where to put my stops? Where do I place them? Guess what? I'm going to teach you that today. That'll be the last thing we do today. I'm actually going to show you where to put stops. And of course, teach you what they are. Right? So these are just a few things that have to go into a prudent risk management plan. Proper order execution, that's easy. it's learning the software, right? So whether you have an account with TD Ameritrade or TradeStation or E-Trade or Schwab or Fidelity or whatever, right? They have their own platform, and obviously they have their own software that you got to learn, right? But that's not hard to do, right? Just learning where the buttons are, where's the buy button, where's the sell button, things like that. How to navigate your trading platform. Anybody can learn that. Market and technical knowledge. How do markets really work? You ever wonder that? I don't know if you're watching a stock. Let's say today we'll just kind of talk stocks. Tomorrow we're going to talk about these leveraged asset classes. But you know why stocks will go up 1 or 2% one day, go down 1 or 2% the next day? I mean, what's really driving these markets? Like, what's really going on behind the scenes? You ever wonder that?
What it's supposed to be and what is it?
Yeah, exactly. That's actually a very good point, right? There's kind of an illusion there of what the institutions or the professionals want you to think compared to what's really going on, right? Let's talk a lot about that today. And of course, these all kind of tie in here. Of course, discipline, as we talked about. In other words, you got to be able to follow rules. That's just the bottom line, right? You get a trade plan, it has rules, you got to be able to follow it. If you cannot follow rules, you're not cut out for this business. No big deal, but it's a requirement, right? It kind of ties in here with the psychology and how to think. So it's kind of giving you that example, right? Okay, in other words, just understanding how to think in terms of odds and probabilities, which is different. If you want to do this for a living, it's a different mindset than if you're coming from, say, a job, where most people have jobs, right? If you're a business owner, is there any business owners in here? Okay, if you're a business owner, you already have the right mindset to trade. Because business owners understand that they can lose money. They get that. So having an entrepreneurial type mindset is very helpful in trading. Because by the way, this is just another business, guys. That's all it is. This is just another business, right? Whether you operate a pizza parlor or you operate a consulting firm or a software company, whatever it is, this is just another business, right? That's all it is. But if you're coming from a job, it's a little bit different. Because with a job, you can't really lose money, right? You know if you show up for 8 hours, you're going to get X amount of pay. That's how jobs work. So this is a little bit different. Of course, the income potential, financial potential is much greater in trading, as it is in pretty much any business than it is with a job, right? Because if you have a job, you work for somebody else, you're capped, right? And you look at them, look at the richest people in the world. Do they own and operate businesses, or are they employees? I mean, nothing wrong with a job, you just have to understand what it is. With a job, you have certainty. With trading or any business, you don't. Right? You have to deal with your thinking in terms of operating with odds and probability and things like that. Right? Confidence takes time. Easiest way to build confidence in the beginning of your trading career is to follow your rules. Follow your rules. That will build confidence, right? Because that kind of ties into the whole discipline and everything. Experience is one thing I can't teach you. And I can't teach you. Can't teach experience, right? I don't know what you guys do for a living, but I doubt you could teach me how to do your job as well as you do in, say, a week, right? It's pretty hard to do. Okay, so this all kind of takes time, but this is all part of what we call our trading foundation. We want to make sure that all these things are present, right? All right, this is probably a good time to take a break. Any questions? Yes, sir.
Excuse me, I'm too frank.
Too frank? That's okay.
Frank, F-R-A-N-K, frank.
Okay.
Okay. I'm doing training more than half a century ago. I'll talk about it. But today, because I attended your first seminar, I thought that was the first year sales technique.
When you say seminar, what do you mean seminar?
Yeah. You got 1 half a day free.
That's the workshop.
The workshop.
Yeah, okay. Yeah, I'm familiar with that.
I expected maybe today I asked, before I register, I said, hey, the next 3 days, what do we make this? They said, the technical what class I said, and so on. I thought something. But today you just said you are orientation again.
Yes.
But I went to university, the orientation after I pay the tuition fee, everything. So now, and after orientation, straight away go to the court. So just now, what you give me an impression, what you say give me an impression, is the second tier sales gimmick. So I think this 3 days we don't expect to learn anything at all.
Oh,
Just
yeah,
orientate into it. And then you are trying to sell how to become a student to pay and set.
well, let me just be clear. Let me just answer the question here.
What you talk just
Yeah.
now is just foundation,
I'm-
nothing, no trick at all.
Okay, well, first of all, let me just say respectfully, we just started.
It
We're
is
only an hour
good, I
in.
tell you.
We're only an hour in. But that's why, and I want to be clear because
You are just foundation,
yeah,
nothing.
this is not. I can't teach you how to trade in 3 days. So
But this 3 days, the next 2 days, what are you going to talk about? The same thing like general, nothing.
well, why don't I tell you what? Why don't you have a conversation with your education counselor? And if this is not right, we can refund your money. That's not a
On the
problem.
phone, I said, I'm going to hear second tier sales gimmick talk.
Okay. I don't know. I don't know about the word
Directly
gimmick,
into the cause.
but
What you say just
yeah.
nothing about the cause, nothing the content in the cause.
yeah. But just respectfully, sorry. We just started though. We're only an hour.
Yeah. Okay.
All right. Let's go ahead and take a break. And why don't you come with me and we can talk with Brian.
Because it's just very.
You don't learn poker in 1 day.
Well, like I said, we just got started. In fairness, we just got started. I mean, if you felt this way after tomorrow, it'd be one thing, but you're not even really giving it a chance. You're kind of calling it a gimmick. You know, to be honest with you. You want to have a conversation? Sure. Okay. All right, guys. We'll just take 10 minutes here.
Yeah, sorry.
No, it's okay. We appreciate your honesty, but like I said, we're only an hour in. You haven't really even given it a chance.
Give you your money back, you can go home.
Huh?
Give you your money back.
Yeah, that's not a problem at all.
Are you? Yes. I think my money is back.
Yeah, okay.
You are on a manager, you are just, nobody ask question, you pretend to ask a question. Something like, casino. Nobody playing, 1 or 2 person playing, but you are employee of the academy. So what just not the question asking?
He's not an employee.
So how can you get me to pay me money? Now you pay me the money, I just walk out. Okay?
Let's go spend a few minutes together. I'll help you.
I told that also is a second tier sales gimmick talk or something into the contents of the course.
Yeah, there was actually quite a bit of content.
Okay, I tell you.
It's okay.
Huh?
Follow me.
No.
Please follow me. Follow me.
Hey, hello.
I'm sorry. Yeah, it didn't work.
No, go ahead.
Question.
Sure.
When we end today?
What time are we going to end today? I usually like to end about 4. I realize after about 7 hours, nothing else is getting in. So we'll be done about 4 o'clock today.
I have to work at 3.
Okay, that's fine. No, that's okay. If you have to leave more early,
If I
I'm
leave
not going to be
early, no. Is anything important the last of 1 hour?
Yes. Yes, because actually today, which I was actually trying to explain to this gentleman, I'm actually going to be teaching you guys the basics of the strategy today. And then, so the last, pretty much after lunch at the end of the day, is going to be on
Really important.
how to find these turning points, where to put your stops, how to assess your risk. That's actually going to be taught today. Yeah.
If it's really important, I just call them.
But if you have to, I understand if you have to work, because I know it's a business day, so you just do whatever you feel comfortable doing. It's fine. Totally up to you. We're here.
Thank you.
Sure, no problem.
This is so funny.
What's that?
This is so funny.
I tell you, I've done like 12 of these orientations. I've actually never had that before.
No, you know what
But
happens?
that's okay.
When you are sick, you don't feel well, then you become negative.
Oh, he's not feeling well?
Yeah, like when you are
It's
physically or emotionally drained, then you get irritable with things because it takes time.
I
It is
understand.
general.
I am 100% not offended.
Yeah.
We're fine with
No,
that.
like I have a lot of young friends, and their mindset is practical.
Yeah.
It is very practical. You go and you are directly to the point.
Yeah.
Okay. And anyhow, so this is just mentality.
Oh, it's okay. Like I said, just I was telling you, it's not for everybody, and we have no problem refunding people's money. No,
So like, I know a lot of theories that last for 5 years, and I had other things, so I'm bringing myself up to date.
Cool.
Because
Awesome.
like, I know how to select the stocks, but markets change.
Yeah.
Now there is daily ups and downs. And like, if I have other things to do and I look and things are going down, then it is automatically, I should be out. Because there are so many pullbacks. And especially now, this is why I'm here, because the market is so overinflated.
Oh my gosh.
And I know summertime, summertime, because of vacations, this is when everybody takes money off the table.
Well,
Like I
like I
want to
said,
learn, I want to learn as much as I can, so October first I'm ready for another up, because there'll be pullback between now and October.
I mean, this is the market right here. I mean, look over here. This is on the big screen here.
Okay.
Look at this thing. This is straight up.
Yeah. So, and it has to pull back.
Well, yeah, we haven't had a significant pullback since 2015 right here.
Because I was looking individual stuff, so like this morning, what they had on NVIDIA and AMD, and that is because of Bitcoin, because cryptocurrencies, because they're buying all these graphics.
Sure.
And I surely looked and bought AMD and NVIDIA starting, but they were all, also overinflated. So the news like this, and you will see them go down.
Yeah.
So if I have time, I will start shorting it. But I need, again, there is news, you need confirmation.
Sure. Yeah, well.
You cannot respond like this. You need confirmation to see if it is, because everybody has now this automated programs.
Yeah. Oh,
and,
yeah.
They go, and so when things go short, they go rapidly.
Yeah. These markets move a lot faster than they used to, right? Because of all that. All that.
So this is what I'm trying to learn. How to identify moves.
We're going to cover that today. Oh, thanks. that?
Try not to be disruptive.
Okay. Well, no, let me just stop for a second here. And I appreciate anybody's opinion. Like I said, if that gentleman, if maybe he had the wrong idea what this was, or the thing that just confuses me, I just want to make sure everybody understands this. But you guys, we don't just bring everybody in here just like you call in, you saw a commercial or whatever. Everybody here, please correct me if I'm wrong. Did some paperwork, right? Something called a TP3. You had a conversation over the phone with your education counselor. Am I mistaken on that? Did everybody already? Okay.
And we went to the 3-hour seminar.
Yeah, exactly. So, and that for our seminar, obviously, is to fill this. And I'm sure Brian did it. He explained to everybody exactly what this is. It's an orientation. Okay. This is not designed to teach somebody how to trade in 3 days for $300.
What I missed.
Right? What you missed. So, with that being said, I just want to, like I said before, but, and again, I respect the gentleman's opinion. It's not for him, or if he was under the wrong impression, certainly not offended, and we actually just gave him a full refund. But just again, I just want everybody to understand, right, my job is not to teach you to trade in 3 days. I can't do that. It would be impossible to do, okay? Just like I said before, when the first 5 minutes we were together, this is an orientation. That's all it is, okay? A lot of people are brand new to trading. They don't know anything about trading. They don't know anything about the markets. Now, that being said, I'm going to definitely teach you some basics today, okay? Did anybody go to college in here? Okay? Like myself, before I attended the college, I went to the University of Washington, okay? I grew up in Seattle. But there were several colleges that I actually applied to, and I actually went down and visited these colleges prior to going to the University of Washington. I actually did an orientation at USC, Gonzaga. Okay, so just like that, when you go to an orientation with a college, right? You're meeting with counselors. You're talking about your career path. You're talking about different classes that might be appropriate for you to take. You're maybe talking to other students. You're checking out the campus, right? Same thing. Okay. So one thing I like to do is, if I do these orientations, is I like to manage everyone's expectations and really understand, this should have been explained to everybody from the start, right? So am I not mistaken? Is there anybody here that actually thought that we were going to teach you how to professionally trade in 3 days? I just want to make sure.
Yeah, we thought that we'll understand the strategies about candidate.
Yes.
Where to put the,
At least the basics or something.
Yeah, absolutely. There's nothing wrong with that. Now, just if I learn can I trade professionally just learning basics, or do you think there's more to it than just basics?
Yeah, but I thought that you'll also tell about the features and forex.
Yeah, and that's what we're going to do tomorrow. So what we're going to do today is I'm going to teach you the basics of core strategy. Okay, and again, these are just basics, right? And then tomorrow we're going to talk about how those basics apply to futures, forex, options, wealth management, things like that.
And some of the chart patterns, like.
Oh yeah, we're going to definitely get into that. Well, that's what I was hoping this gentleman would have maybe stayed around to the end of the day. He might have had a slightly different opinion at the end of the day, just being an hour in. But that's okay. That's okay.
Still going to learn a lot in 3 days.
Yeah, well, one thing you're going to learn is, hey, is this for me or is it not for me? Or, obviously a different way to look at the markets. Understanding how they really work. All right. So any more questions before we continue on our journey?
Let's do it.
All right, let's do it. Okay. All right, so let's talk a little bit about, every time we put on a trade, oops, I'll do that here in just a second. We want to make sure that we have these 3 elements present, right? An entry, a stop, and a target, okay? In other words, when I put on a trade, we're exactly in our entry into the market. And if I'm entering a trade, there's 2 types of entries. There's going to be an entry long or an entry short. So what's the difference? Well, if I'm long, I want you guys to think buy. Okay, so let's say the stock's at, let's say, $40. Okay, and I feel like the stock's going to go up. So let's say I bought it at 40 and I sold it at 50. Right, so this is going to be buy low and sell high. Everybody gets that, right? I buy low, I sell a little bit higher, I'm going to make some money. Okay, but what if the stock's at 50, and instead of thinking that it's going to go up, I want to make a bet that it's actually going to go the other way. It's going to go down. Okay? What's that called? Robert? You said it earlier, right? Shorting. Everybody said it, okay. That's shorting. Okay? Now, shorting is a sell order. Okay? Now, obviously I can buy something and then hopefully sell it at a higher price, right? But how do I sell high and buy low? Right? In other words, how do I sell something that I don't have? Who do I borrow it from? Broker. Excellent. Okay. Okay. So the mechanics of shorting are a little bit different. Okay, behind the scenes of actually what's going on, because when I'm going long a stock, I simply buy the shares and then hopefully sell those shares at a higher price, right? If I'm shorting a stock, what I'm going to do is I'm going to borrow shares from the broker. So let's say the broker is going to loan me 100 shares, okay, at $50. So he's going to loan me 100 shares. I'm going to sell it at 50, which is going to generate a transaction, $5,000 transaction when I do that, right? 100 shares times 50. Now, let's say it does go down to 40. Okay, so once it goes down to 40, then I'm going to basically buy those shares back. Okay, it's actually called to cover, buy to cover. So I'm going to buy those 100 shares back at 40, which is going to cost me how much? 4,000, right? Okay, and then of course those shares go back to the broker. Now, this is what's going on behind the scenes. It's just a button. You know, it's not like you're calling your broker up and saying, hey, you know, you can ask me this. Can I borrow some of those shares of ABC stock? Right, it's just a button. In other words, you hit the button. That's what's going on behind the scenes, right? This all happens in kind of a nanosecond, right? So I borrowed the shares at $50, 100 shares at 50, generated a $5,000 transaction, bought them back at 4. What did I keep? I kept the difference. Okay. So let me just kind of give you guys like a little analogy to help you kind of understand shorting, because sometimes it gets a little bit still confusing if you're never shorted before. This is the first time you're hearing about shorting. So let's say that here's a good one. Let's say that my next door neighbor just bought a brand new lawnmower. He just paid $400 for it. It's brand new. It's never been used. Shiny red lawnmower. $400. He just paid for it. He's getting ready to go on vacation. But before he does, he comes over and says, hey, Scott, you know what? I'm going to lend you my lawnmower. I'm going to go on vacation. I'll be back next week and give it back to me then. I said, okay, thank you very much. So he brings over his brand new $400 lawnmower. So he lends it to me. Then he goes on vacation. But instead of using it, I decided to take a picture of it and put an ad to sell it on Craigslist. Okay? So I put an ad on Craigslist and say, brand new lawnmower, never been used, $400. An hour later, guy calls me up, says, hey, I saw your ad, looks great, I've been looking for a lawnmower, I'll be right over to pick it up. So he comes over, he gives me $400 in cash, I help him load the lawnmower onto his truck, and he drives away. All right? So what did I just do? Besides potentially upset my neighbor. What did I do?
Sold.
I sold it. What else? Sold what? Sold something I owned. Yeah, so I sold something that didn't belong to me, right? I sold something that was lent to me. Now, if I don't produce this lawnmower by the time the neighbor gets back, he's going to be pretty upset with me, right? Rightfully so. What I didn't tell you, though, is they're running a sale for lawnmowers down at Home Depot. So I go down to Home Depot and I find the same make, model, everything, exactly the same lawnmower on sale for $200, half off. Right? So I take $200 out of my pocket, pay for the new lawnmower, bring it back. My neighbor comes home from vacation. I say, thank you very much. I give him back his lawnmower. It looks exactly the same. He can't tell the difference. Exactly the same. And I kept $200, right? So again, what did I do? Right? I sold something that was lent to me, and then I bought that same item back at a lower price and kept the difference. That's all shorting is, guys. That's it. Okay? Go ahead.
Question.
Yeah.
What if you get down to the place that's having a sale and they don't have them?
Well, again, my example is just to give you an analogy to understand the
Yeah,
mechanics
that
of it.
happens.
So you're saying, what if, or are you asking, are all stocks shortable?
Yeah.
No, they're not. They're not. If you're going to trade stocks, you have to learn.
He's asking, are they going to be available to buy back? And the
Well, certainly. Well, yeah, of course. Okay, but again, not every stock is shortable. In other words, the broker has to have the shares of that stock in inventory to be able to lend to you. If they don't have it, they don't have it. So now, if you're in the stock class, if you're learning how to trade stocks, there's a bunch of criteria you have to learn, like minimum volume and things like this. If you're trading, which is what we trade, the NASDAQ 100, S&P 100 stocks, in other words, your Teslas or Bank of America's, Boeings of the world, Apple, Google, those stocks, those are all shortable. You're never going to have a problem. They're highly liquid. But there could be like some local credit union here, something very low volume stock or whatever that's not shortable. So yeah, to answer your question, not all stocks are shortable. If you're sticking to highly liquid stocks, you're not going to have that issue of trying to buy it back. So,
How does it go wrong on the short?
well, I haven't got there yet. So we'll talk here when we get to the stop. You'll see. Okay. Now, just before we get into stop, just understand when you short a stock and it goes up, you lose money, right? In other words, the opposite. Just like if I buy a stock and it goes down, I lose money, right? So remember, you're just playing the opposite side of the market. Now, the next thing is, just so we kind of understand here, what's in it for the broker? Why would the broker allow me to, why would the broker loan me shares? I mean, what's in it for them?
Interest rate.
A little bit. You will, whenever you borrow anything from a broker, whether it's shares or if you borrow money to buy or short stock, which is called margin, which we'll talk about more later, they always charge you an interest rate. Okay. Now the interest rate, it can be as low. I use a broker called Interactive Brokers. They charge 3.5% annualized. So if you have a position for a few days, and we're talking pennies. What's really in it for the broker is the transaction commission. Okay, because every time you trade, you get into a trade, long or short, and then you exit the trade, right? You're going to be charged a commission. So if you're with, say E-Trade, which I think charges $5 a trade or whatever, right? So as soon as if I buy a stock, $5. Once I get out, $5, $10 round trip. Same as when you short. I short at $5, buy it back $5. So what's really in it for the broker is the commission. That's where they really make most of their money. Okay, that's what's in it for them. Okay, but we want to be able to play both sides of the market. Otherwise, if you're just on the long side, that's not going to work very well when the market's crashing, right? In fact, you can actually make more money in a down market than an up market. Do you know why that is?
Stocks fall faster than they run.
Absolutely. Why is that?
Everyone gets scared and runs.
It's because the two major emotions in trading, fear and greed.
People start dumping each other.
Yeah, fear is, they're both strong emotions, but fear is actually a stronger emotion than greed. That's the reason. In fact, you can go back and look at, you go at the last 100 years of the stock market. You could look at every single significant crash that we've had, which is 30%, defined as a 30% decline or more, and you will notice that those crashes tend to go much faster down than the up market that preceded it. Here's a perfect example, the last one. From 2002 to 2008, we had a 6-year bull market. And I'll show you when we go to the charts, I'll show you this graphically as well. But we had a 6-year bull market from 02 to 08, up market. And then what happened in 08? Market crash, right? All those gains, 100% of those gains, from 02 to 08, the market actually fell in the next 18 months. It erased 6 years worth of gains in 18 months. From September 2008 to the March 2009 low, right? It's about 18 months. Okay, so they fell much faster again because of that panic selling, as I think you tested to, is a stronger emotion than greed. Right? So when you're shorting, you can typically you're going to make money at a faster rate because the moves are typically more exasperated to the way down for those reasons. Okay? So the entry can either be long or short. So if I'm entry long, this means I'm buying. And if I'm entry short, it just means that I'm shorting. I'm making a bet that a stock's going to go down. That's all. Okay? So we see kind of right here, if our entry is $12.50 and our stop is $11.50, in other words, if price comes down, we buy it at $12.50, but it hits $11.50, we want to be out of the trade. So what's my risk on this trade per share? $1, right? Okay. And I want to make sure, we're going to talk a lot about this today, especially tomorrow, which we talked about here in the beginning about reward to risk, right? In other words, when I'm wrong on the trade, I'm going to lose $1 in this example. If I'm wrong, I'm going to lose $1 per share. Okay. But when I'm right, I want to make at least 4 times more than what my risk is. In other words, if I'm risking $1 to make $4, does Is that a pretty good reward to risk, you think? I mean, think about it. If you're doing a 4-to-1, right, you can actually have 4 losers in a row. And then one winner wipes out all those losses. Okay, so you want to cut your losses, but you want to ride your winners. And 4-to-1 is just a minimum, in fact. I mean, sometimes, you have to understand, not every trade is created equal. Some trades actually have a lot more potential than another trade. Okay, so the entry is really the act of opening up the position in the market, either long or short. Okay, again, there's a time to be a buyer, there's a time to be a seller. Right? Now, what if we're wrong? You're wrong sometimes, right? Right? If you're wrong, you're wrong. Right? We're going to lose money, but we want to lose small. That's the whole key to trading. Okay? When you're wrong on a trade, you want to cut your losses. Okay? You want to lose small. Now, how do we do that? How do I set myself up to get out of a trade if I'm wrong? What's called a stop loss. Okay? This is the most important part of any trade is your stop because it's your protection.
One question. So
Sure.
if the graph goes up and down, right?
Mm-hmm.
So it could be that it just triggers touch stop loss and then again it goes up.
That can happen, yes. Welcome to trading. That does happen. Sometimes it'll come right in, stop you out just by a little bit, and then go to the moon. That does happen. But that's going to happen a lot less if you place your stops correctly, which I'm actually going to teach you that today. I'm actually going to show you exactly, once we're going to get into the charts, and I'm going to teach you actually where to put those stops. If you place the stops correctly, that's going to happen a lot less. But it's always going to happen.
And just one more note that the 4:1, right? So if we increase that 4:1 ratio, so if we increase the 4 ratio to let's say 5 or 6, the reward basically, like 50 to 60, 50. So if,
Right.
so if we increase that, the chances of the risk also are more because you're trying to keep the trade for a long time in the market, right?
Well, your risk is just going to be your distance between your entry price and your stop price, right? That's your risk. That's always your risk. Whether that's $1, 50 cents, or $2. Again, you just want your reward to be at least 4 times that amount. Okay. And again, we're going to get into this after lunch. We're going to dive into these charts. So you guys are going to get a lot of stuff today. Right now, again, I have to teach you some of the basic terminology before I start throwing charts in here. Okay. So we just got to learn some basics right now, some terminology. So the stop is the point where I'm proven wrong. That's all it is. Right? It's how I define my risk on the trade. If I say I only want to risk $100 on this trade, how do I do that without a stop? Right? I have to have a stop to define or quantify that $100 risk. If you don't have a stop, guess what? Your entire account balance is at risk. Right? Because you could get into a position that just you bought a stock at 50, but now it's at 40 or 30 or 20, right? You're just losing money. Eventually, that could equate to your entire account balance, right? Which we don't want to blow up our account. So the stop's the most important, the most critical element of any trade, is having that stop, right? Very, very critical. It allows you to take small losses. It's a cost of doing business. Psychologically, most students don't like taking losses. I understand that. It's not like I love taking losses. Nobody does. But you have to understand it's a cost of doing business. Okay? It's like if you want a pizza parlor, you're going to have to buy cheese. Are you going to get upset because you get the cheese bill? Well, maybe you will, right? Nobody loves paying bills, but you understand as a business owner that you have to pay for cheese. Well, taking small losses, guys, is a cost of doing business in the trading business. That's all it is. And you have to look at it that way. You're going to be wrong sometimes. It's okay, right? Take the loss. You go into the next trade, and the most important thing, don't let it bother you psychologically. Don't dwell on it, right? Move on, okay? What about the target?
Don't be too greedy.
Don't be too greedy? Yeah, we don't. Now, let me just go back to the stop for just a second, actually. Let me just show you kind of psychologically why this is always important before we get to the target. But if I have a stock, let's say let's say you want to buy ABC stock at $50, okay? So you've done your analysis and you've decided that $50 is a good place to buy ABC, right? So you put an order in to buy ABC when it hits $50. Maybe it's at $52 or whatever it's at. So it comes down and you buy it, right? 100 shares, 1,000 shares, whatever it is. Now, does everybody agree you're only buying it at 50 because you think it's going to do what? It's going to go up, right? Why would you buy a stock if you thought it was going to go down? You wouldn't, right? So obviously you buy it at 50 because you think it's a good place to buy, but it doesn't go up, it keeps going down. So now it's at, let's say now it's at 40. So how you feeling at this point?
Why didn't I put my stop loss in?
Look at it right there.
49.
Hold it, yeah, you're already ahead of me, man. Okay,
Yes.
but you bought it, and you're right. But if you bought it, what I'm trying to do is I want you guys to get it, to think about, project yourself into situations so you can understand the psychology. You bought it at 50, and now it's at 40. And you're feeling what? How are you feeling now? Probably not very good, right? Okay. Why, if you're still in this trade, what are you telling yourself? What are you trying to convince yourself is going to happen? It's coming back, right? Sometimes I hear that. It's not really a loss unless I sell, right? Okay? So you're always thinking, well, it's coming back. And sometimes they do come back. Sometimes they don't.
Most of the time they come back eventually.
Well, it depends. Well, what's eventually?
Right.
Yeah, you're 70 years old, retired. You got half your money in the market. You're going to let it draw down 50%, right? So it depends on some factors, right? By the way, can stocks go bankrupt? Can stocks go to zero?
Yes.
Absolutely, right? Okay. So it's coming back, right? You're telling yourself it's coming back. I think it's coming back. Please come back. It may not be coming back, right? So maybe it's like $10 now, for example. So my point is this. Do I really need a $50 stock that I bought at 50 to go all the way down to $10 before I have the realization that $50 was not such a good place to buy? Hopefully not, right? So make the math easy, Robert. Maybe I have a stop at 49 as an example, right? I'll teach you later where to put your stops, right? In other words, if I buy at 50 and it hits 49, I'm out. So I'm not going to allow this thing to go to the ground. So I'm going to take a loss, but I'd much rather take a $1 per share loss than say a $30 per share loss, $40 per share loss, right? Okay. The key to this game is, like I told you, not to lose money, or if you're going to lose money, you want to lose small, because it only takes one trade, just one, to decimate your account. I mean, think about this, right? If you allow your account, and one trade can do this, by the way. If you allow your account to draw down 50%, in other words, let's say you got 10 grand, and you're in one bad trade. Now your account balance is 5. You started with 10, now it's 5, right? You're not using the stock. So you've drawn down 50% of your money, right? You've lost 50% so far of your money. What return do you have to get from that point just to get back to break even? 100%. Think about that. Okay? No, a lot of people don't know that. When they do the math in their head, they don't understand that until they kind of think about it. So you lose half. You now need to double your money just to get back to where you were, right?
And you have less leverage to do it with.
Sure, you're using leverage with margin.
Or you have just less to do it with, period.
Less buying power, of course, right? Yeah, absolutely, right?
So it takes longer.
It could take longer, okay? But again, what's the moral of the story? The moral of the story is don't allow my account to draw down 50% or more, which is exactly what people do in 401k accounts, don't they? Can you put a stop loss on a 401k account on any of these mutual funds that you're invested in? Isn't that interesting? You know, every asset class out there allows you to put stops, except for mutual funds. Did you know that? The stocks, futures, forex, options, all allow you to use stop losses, except for mutual funds. There's a reason for that.
They don't want anybody.
Well, again, I don't want to jump ahead, but we'll talk a lot about mutual funds. Okay, so the stop again is just the cost of doing business. Lose small and don't let it bother you. You know, learn from your trade. Okay. By the way, you'll learn a lot more from your losers than you ever will from your winning trades. The losers will teach you a great lesson, especially in the beginning. Okay, because you want to make sure it's a good loser, not a bad loser. You know the difference between a good losing trade and a bad loser? Even if the dollar amount's the same, what do you think the difference in a good loser or a bad loser is?
Well, you came out earlier.
The trade plan, right? In other words, discipline. Did I break my rules? If I broke my rules and I lost, that's a bad loser. If I did everything correct to my trade plan and the trade just went against me, that's a good loser. Right? So it all comes down to that discipline of following your trade plan, following your rules. Okay? But there's no way around this. You're going to get stopped out sometimes, guys. That's just the fact of trading. Okay? What about the target? What if I'm right? What if I bought at 50 and now it's going to the moon? Then what? At what point do I take profits? Because otherwise it's unrealized, right? I mean, look at, we can go back and look at the NASDAQ in the 1990s. started from, kind of going back to like the 94. In other words, everybody is seeming rich in their 401k retirement accounts are feeling rich. And then within a year, gone, evaporated.
I found out my favorite way of doing that for what's called FOMO, fear of missing out,
Oh,
is
yeah.
to put a trailing stop in.
Yeah, it's still a stop, right?
It's still a stop.
But now I wouldn't recommend using it. I'll show you a much better way to manage a longer-term trade. Use something called technical stops, which I'm actually going to teach you that this weekend.
Where you do quant.
You're moving your stop, but you're not. It's not based on a trail like an arbitrary number.
Right, that's what I need to learn. That's what I'm here.
Okay, good. All right. So the target again is the point where you're proven right. Okay, and it has to be predefined. By the way, let me just be clear. Every time we put on a trade, okay, it's not like you get into the trade and then you figure out where your stop or your target's going to be. Everything needs to be pre-planned prior to actually pulling the trigger on that trade. Here's my entry, here's my stop, here's my target. Or targets, I can have more than one. We call that a bracket order. It's a bracket order because your targets and your stop is bracketing where you enter. You get your protection to the downside if you're going long, and then you got your profits above you, right? So let me just tell you a story of, I have a neighbor, his name's Jim, and he lives a few doors down from me for the last 7 years. And he's a great guy, but for the longest time, Jim was always asking me trading advice, or here's a conversation. Hey, what did you think of the market last week? Or where do you think the S&P is going to be between now and the end of the year? Okay, so let's just tell you a story. Now, this is probably about 4 years ago, but I'll never forget this story. So Jim, we live in a cul-de-sac, and he's always out walking his dog. If I'm out there, we'll kind of, we'll shoot the breeze a little bit. And again, for the longest time, he was always asking me about, trading advice or stock tips. He recommended good stocks, things like that. Well, again, this is about 4 years ago. He was telling me, or out there talking to him, and he was telling me about a stock that he had recently bought. And he was all proud of himself because he bought some stock. I don't remember the ticker, but I want to say he bought a stock like at $8, and the thing shot up to like $15. And he was like on cloud nine, really proud of himself. Now, I usually don't like to pry in people's business or talk about, unless I'm in a class, I like to kind of like keep to myself. But I've known Jim for a while, and I was just curious, so I decided to ask him, even though I knew what the answer was going to be. So he's talking about the stock he bought at 8, it's at 15, it went to $15. I said, wow, that's an awesome move. That's almost a doubler, right? So I asked him, I go, what price did you get out at? Guess what the answer was? 12. Didn't go in, it never got out. Yeah, I think he said like it's a long-term holding, or I added it to my portfolio or something. In other words, just buy and hold, right? We've all heard that term, buy and hold. So I'm thinking to myself, okay, wait a minute. Okay, this stock doubles. You're not going to take something off the table, right? So let me just tell you how this ended. So fast forward about 6 weeks. Jim's got a 9-year-old daughter, and we're over. I have an 8-year-old, and he was over for my kid's birthday party, and we started talking about the market and stuff. I decided to bring it up because I was really curious. So I said, Jim, I go, how's that one stock doing that you bought that you were telling me about a few weeks ago? And he goes, which one? I said, the one went from like $8 to $50. Oh, yeah, I still have it. Uh-huh. What's it at? Last time I looked, it was about $6. Ooh. Okay, so you bought it at 8. The thing goes to 15. Who knows? I wasn't following. The thing might have gone to 100 for all I know, right? And it comes back less than what you bought it at. That's an amateur move. You take anything off the table. Let me just say something right now, okay? Buying a stock that doubles, buying stocks that double is hard to do. That's hard, okay? You're not here. I'm not here to teach you what the next Apple is going to be or what the next Microsoft, right? Because it's very difficult to do, right? Day-to-day trading is much more like finding small bounces in the market, right? And you can make a very good living off small bounces in the market. You can make a living on a 30-cent move a day. 2,000 shares, that's $600. A few times a day, that can really add up. What I'm trying to say is, I don't know how many sports fans are in here, but using a baseball analogy, it's about getting on base. It's not hitting singles, not home runs. Okay. Now there are definitely times where the market lines up where you want to swing for the fences, but most of the time you're just after little bounces. In other words, it's much, much easier for me to predict a stock, a $50 stock going to $55 than it is predicting that $50 stock going to $500. Much easier. Okay? So we want to get into the mentality it's about little tiny bounces each day. It's much easier to trade that way. You get a doubler, You get a stock that goes from $8 to $15 or $16, and you don't take it off the table, or at least sell half your shares. That's an amateur move, because that's difficult to do. Okay, it's not about finding stocks that double or triple or quadruple. Yeah, sometimes that happens. It's about little bounces that happen every day, right? So again, it's kind of the mentality, right? And of course, that risk management, right? Losing small and being able to obviously take profit once you get that nice little bounce, right? Which is at least what? 4 times your risk. If I'm risking 50 cents on the trade, my minimum target is going to be what? $2. Okay. So every time you put on a trade, is this a good entry? Right? They'll learn that, right? The trade goes against me. Where am I getting out? Which is called a stop. And then if things go my way, where am I getting out? If things go right, right? Which is a profit target, right? Okay. Here's an acronym to help you remember that. We want to set up our trade. Every time we place a trade, we want to make sure we set it up. Stop, entry, target. Because if I don't have a stop, how can I define my risk? I can't, can I? Right? And then where am I getting out? Again, there's nothing worse. Can you imagine buying a $10 stock, having it go to 100, and then having it come back less than you bought it at? How depressing would that be? Right? That would just be taking profits along the way. Okay? Now, let me just say this. There are certainly times, as I mentioned a second ago, where you do want to swing for the fences. Okay? In fact, we're kind of in an interesting time right now in the markets because we're obviously at all-time highs. This market is defying gravity. In fact, this market, we'll compare a little bit later, this market looks and reminds me a lot like the NASDAQ in the late 90s. It has that low vertical parabolic type move. You know, it's been going on for like 8 or 9 years now. A lot of similarities between these markets, right? We'll compare a little bit later on, right? But, you know, we want to make sure, right, when these markets turn, when the next crash happens, right, there is no better trade than to be shorting a bubble that's popping. I mean, who would like to go back to 2008 and start shorting this market? Right? Of course, or 2000. Okay, but everybody's on the long side, right? In fact, because you don't understand shorting, if a market's going straight up, once it starts crashing, we start thinking, oh, this is a buying opportunity to get back in. Buy it at 100, goes to 90. Well, it's $90. Cost averaging, right? Isn't that what brokers tell us? You like the stock at 100, it's now at 90, so you buy a whole bunch at 90. Now it's at 80. Now it's at 70. So you're buying it on the way down. That's another reason how these markets start to get exasperated and move down, because all the professionals are selling to the novices or amateurs that are buying in at lower price because they don't realize the bubble's popping. And so they're taking the other side of those trades. Because every time there's a transaction in the stock market, there has to be a buyer and there has to be a seller, doesn't it? In other words, if I want to buy some IBM stock, right, I have to convince somebody to do what? Sell it to me, right? If I want to sell my Microsoft stock, somebody has to do what? Somebody has to buy it. So just remember, there's always somebody on the opposite side of the transaction. Every time you take a trade, there's always a buyer and there's always a seller. Okay, we want to be obviously on the right side of that trade. Okay, so here's our core strategic principle. The lowest risk, highest reward, and highest probability entry point to the market is going to be at or near the turn in price. Okay, now what does that mean, for example? Well, let's take real estate. Real estate, everybody understands real estate. Very easy to understand. If I have two investors, if I have investor A buys a piece of rental property in 2007, compared to investor B buys a piece of property, similar property in 2011, who's doing better right now in terms of appreciation? Who's doing better? The person who bought in 07 or the person who bought in 2011? You think in 07 is doing better than 11 or other way around? Well, what's the problem with buying in 07? Yeah, right? You're buying at the top. Now, of course, we didn't know at the time that it's hard to predict the exact top, right? But think about this for a second, right? It feels much more comfortable, real estate included, to buy when a market's going up compared to when it's going down, right? Because if you go back to 07, kind of